In this video, we will talk about the importance and great impact accounting has in the business world nowadays. We will explain different reasons that accounting is becoming an international topic and has evolved from its roots to become a detailed process in the registration of operations in the multinational corporations emerging around the globe. Chapter 1. Introduction to International Accounting. Chapter 1 starts by discussing the term international accounting and its importance in today's economy. The author mentions 3 levels that exist in this topic. The first level being the one where organizations such as the United Nations or the International Federation of Accountants set the guidelines and rules for the accounting process. The second level being the one where the companies follow the standards for the international operations. Finally, the third level being the one where each country sets its own rules or guidelines for auditing, taxation, cross-selling, or other transactions.
Chapter 2. Worldwide Accounting Diversity. Chapter 2 provides a detailed example of how companies that starts operating in the US turns into a multinational corporation due to the new transactions it has to provide in order to grow and expand. Due to the new expansion of a company to other countries, it encounters problems that it had not experienced before. Such problems involve taxation, currency exchange, and the different legal systems in each country. All these new changes are occurring due to multinational corporations arising around the world. Big companies that operate in different countries around the globe must hire accountants and lawyers that are familiar with these new regulations and techniques. Partners, owners, and other users can make correct decisions so that companies can expand and earn a bigger profit. For this reason, companies must make sure to register all their transactions according to the policies each company has in its own country. For this to take place, companies must make their financial statements public so that different organizations can validate them. Financial statements can also be useful for people that want to invest in these companies, so that they have a better idea of what the company is made of. The main topic in Chapter 2 are the different legal systems that exist in the world. The importance of these legal systems is that the laws applied in each country will determine the way a company registered its operations. These 2 legal systems are common law and Roman law. Common law is found primarily in English-speaking countries. The main difference between these 2 is that in common law, the primary source of accounting comes from the non-governmental organizations, which means that there are less regulations coming from a national legislature. On the other hand, code law countries have more regulations coming from legislature, which tend to give the accounting profession less influence over the development of the standards needed to develop financial operations.
Chapter 3. International Convergence of Financial Reporting. This next chapter talks about the problems some companies encounter due to the convergence of their financial reporting. Because of the subsidiaries multinational corporations own in different countries, some of the main issues are confronting the preparation of consolidated financial statements. This is a problem because of the different methods and rules each country has for creating their financial statements. Another problem is the access to foreign capital markets. This means that a company, in order to borrow money from a foreign country or sell their stocks in a different stock market, is forced to present its financial statement in accordance with the standards of the country from which the money is obtained. Another 2 factors that come as a problem are the comparability of financial statements and the lack of high-quality accounting information. These issues all have to do with the fact that every country has different methods of registration and different legal systems. All this leads to the need of international accountants that are ready and prepared to face all these kinds of issues in order to help a company grow and operate in different places around the world. Chapter 4: International Financial Reporting Standards, IFRS. While practicing international accounting, there will be many obstacles that will come across the different methods utilized by every country. In accounting, like in other careers or jobs, there are sets of rules or principles that must be followed in order to keep transactions transparent so that entities like banks, investors, the government, or people that want to buy stocks can understand and easily identify the economic situation of the company. Another reason why it's important to follow a set of established rules during the practice of accounting is so that companies have a guideline of how to register the different movements their company makes. Chapter 4 talks about the differences that exist among the IFRS, International Financial Reporting Standards, and the US GAAP, Generally Accepted Accounting Principles. Recently, the differences between these two methods have been reduced in order for countries to have similar accounting principles. Some issues, such as definitions, recognition, measurement, alternatives, requirements, and presentation differences, have all been taken into consideration in order for countries to have less trouble while having subsidiaries or making transactions in multinational corporations. Chapter 5: International Financial Reporting Standards 2. Chapter 5 continues talking about the rules and guidelines of the IFRS for the elaboration of the financial statements. This chapter emphasizes in the recognition of liabilities and its different form of presentation. There are two types of classification for liabilities: those that are current and non-current. Current liabilities are those that the company considers will be settled or covered in a short period of time. The author mentions income taxes are recognized similar in both US GAAP and IAS. The differences each system has in the registration of their revenues, liabilities, taxes, and assets are due to the way each country operates and the necessities every one of them has. Although nowadays these differences are being reduced because of the constant global operations companies are having, so in order for multinationals to have less complications, the different standards must be in a future turned into a single set of standards that regulates all countries.
China. Accounting and auditing have taken different paths in China. Auditing firms mainly audited domestic companies, while accounting firms focus on foreign companies. China has a market-oriented legislative and judicial system, which helps the accounting profession. The recent economic programs stimulated the growth of the accounting profession, and the recognition of the joint stock company form increased the demand for reliable financial information. Government regulations require the involvement of independent auditors and an annual audit of financial statements. There are clear signs that the Chinese have adopted American principles. Germany. The primary source of finance for German companies is bank loans. This translates in a high demand of financial reporting experts. Auditing dominates the accounting profession, which is headed by the Chamber of Commerce. The German Commercial Code contains most of the financial principles, which include a principle of prudence. The primary function of financial accounting is the conservative determination of income. German accounting is heavily influenced by tax laws. Since 2005, German listed companies are required to use IFRS when preparing consolidated financial statement, but there are still some inconsistencies between the German rules and the IFRS. Japan. The Japanese economy is dominated by the keiretsu. The Japanese accountants have a low social status and independent auditors are not accepted in Japanese companies. The main source of finance are banks and cross-corporate ownership. Corporate earnings are regarded as a source of funds and not as a measure of performance. Stock exchanges are government regulated by the Ministry of Finance, which is responsible for developing financial reporting standards. Financial reporting standards are heavily influenced by tax law. Major attempts have been made to ensure that Japanese accounting standards comply with the IFRS. United Kingdom. Capital market provides the main source of funding for British companies. The main purpose of accountants in the UK is to provide information for financial markets. Accounting in the UK has a principles-based approach. Regulations have been left in the hands of accountants, as they didn't feel the need to have a powerful commission to regulate the profession. Accounting principles and practices in the UK emphasize the investor's needs. Companies are required to provide true and fair value of their financial position. Since 2005, UK's companies are required to use Europe's IFRS on a historical cost basis.
Chapter 7. Foreign currency transactions and hedging foreign exchange risk. When talking of international accounting, one of the major topics is foreign currency, which is of great importance to companies because a bad decision in this topic can cost millions in losses. There are many currencies in the world. Most of them are able to fluctuate in value over the time. The rest are fixed against other markets, such as the US dollar, or to another measure of value such as gold. The rate at which a currency can be bought today is called the spot rate. Forward rate is the price that can be locked in today for a future transaction. This rate can either be direct or indirect quotes, depending on the currency used as reference. Direct quote tells you the number of dollars for a foreign currency unit, and indirect quote vice versa. When exporting or importing in foreign currency, exchange risk is created. An increase in the value of the foreign currency will result in an exchange loss. The same happens the other way around. A decrease in the value of the foreign currency translates in a foreign currency gain. Foreign currency balances must be revalued to the domestic currency on the date financial statements are prepared. The gains or losses are recognized on the income statement of the period in which the exchange rate change occurs. This is known as the two-transaction perspective, accrual approach. To eliminate the risk, companies use hedging, which is done by establishing a price today at which the foreign currency will be sold or purchased in the future. Companies use forward contracts in which they set a specific rate for a future date with banks to protect themselves from currency loss. There is no cost to enter this option. The company must honor the contract and buy or sell even if the current market price is better. There are other types of options that can be used in which companies have the right but not the obligation to use the established rate. The value of a foreign currency option can be determined through the use of an option pricing formula, such as Black-Scholes.
Chapter 11. International taxation. Like we mentioned earlier, international taxation is one of the most important topics in international accounting. The reason why taxes are so important among companies in different countries is due to the high costs these represent. Chapter 11 talks about the relevance taxes have in deciding which country is ideal for multinational corporations to operate in. For example, around the world, there are some countries known as tax havens due to the low rate these have on taxation, which is why companies that reside in countries with high tax rates like the US go to these tax havens in order to reduce their costs. The two most important types of taxes are income taxes and withholding taxes.
Chapter 12. International transfer pricing. Transfer pricing is the method used to set the price for goods and services sold between a subsidiary and parent company. There are two factors that influence the way in which transfer prices are determined: corporate objectives and national tax laws. Through transfer prices, multinational companies attempt to reduce costs, especially taxes. However, multinationals must be really careful not to break any tax law setting these prices. There are three major methods to establish transfer pricings: cost-based transfer prices, market-based transfer prices, and negotiated prices. Each one is appropriate in different situations. Multinationals consider two objectives in determining transfer prices: performance evaluation and cost minimization. Transfer process affect the reported profit for both parties, revenue for the seller, and cost for the buyer to evaluate performance fairly. Transfer prices should be acceptable for both parties. If not, dysfunctional behavior can occur. Transfer prices can help multinational corporations reduce worldwide taxation, minimizing import duties, improving subsidiary position of foreign countries, among other things. These objectives, more often than not, conflict with one another due to their nature. National as well as multinational laws have been created to prevent companies from using this method as a tax evasion form. Guidelines regarding the acceptable transfer price methods have been issued by tax authorities. Most of this based on OECD guidelines. The basic rule this guideline said is that transactions should be made at arm's length price, which is the price at which two unrelated and non-disparate parties would agree to a transaction. Companies try to achieve cost reduction objectives by selecting prices at the extremes of the relevant range. Advanced pricing agreements can be made between the company and national tax authorities to agree upon the used method.
Chapter 14. Comparative International Auditing and Corporate Governance. Auditing is one of the most important issues multinational corporations need to attend. Auditing can improve the precision, quality, and reliability of financial information. This can translate to enhanced investor confidence, which is crucial due to the current trend toward market globalization and rapid growth of international transactions. The OECD Code for Corporate Governance emphasizes that auditors should be accountable for shareholders and that boards of directors should oversee the financial reporting function. The Sarbanes-Oxley Act introduced new measures to improve corporate governance. Some of these measures include the establishment of new oversight board for the accounting profession, tightly defining independence of an audit committee member, requiring external auditors to report directly to the audit committee, and the provision of certain non-audit service by external auditors. Each country has its own rules regarding external auditing, which include the purpose, environment, regulations, and report of the audit. The purpose and environment of external auditing can be very different between countries due to the differences in accounting infrastructure. Some countries leave auditing largely in the hands of the profession, and others rely heavily on the government. Many countries are trying to harmonize auditing standards to assure the international capital markets that the audit process has been consistent across companies. The responsibility for developing international auditing standards rests in the International Federation of Accountants. In recent years, issues concerning auditors' liability have been subject of debate and discussion. Accounting firms strongly advise that auditors' liability should be limited. Sometimes, auditors include disclaimers of liability in their audit opinions to protect themselves from unintended liability. In conclusion, international accounting is becoming a topic of more relevance due to the growing number of multinational corporations. As long as more companies start transactions in other countries and have to encounter issues like taxes, accounting standards, or law differences, more and more accountants will have to study international accounting to help benefit the companies they work in with all the opportunities being a multinational corporation offers.